around trading and understanding what you are doing. Last week, it was a lot about what those things are that you could trade. We talked about stocks. We talked a little bit about bonds. Mostly we focused on the differences between exchange traded funds, mutual funds, and even dicing up the market in general, talking about sectors, talking about a few different ideas on how we can understand better both our own portfolios and the market in general. The whole goal is to start leaning into this idea that maybe there is some value that I could produce as a result of my decisions in the investing and trading world. So there is a lot that we can walk through as we go through this presentation, but our intent is to make sure that we present to you some of the key ideas that will help you understand best what we can learn. So the first thing that we brought up is this one, a copy of the homework. I'll go ahead and bring it in front of you now. Here it is. This is a copy of the homework. Like we said, this could be found at fidelity.com/classroom, fidelity.com/classroom. Then you scroll down a little ways to the how to trade page, and then you clicked on the link for the homework. Here we've got week one's homework. We're going to review this really quickly, and then Troy, I'll pass it over to you to go ahead and launch us into the material for the day. But as we take a look here, folks, my goal is to go ahead and answer any of your questions, but we find ourselves just a little bit disadvantaged today. There was something strange that went on with the Zoom settings, so unfortunately, you are not going to be able to type in your questions like you did last week. Troy and myself are lamenting that already. We've genuinely appreciated the opportunity to interact with your questions. Don't worry, that will be fixed shortly. We expect that by the time you're back here next time, we will be able to do those again, but we will do our best to use our telekinesis or some other telepathy, some sort of mental ability to figure out what it is that you might have a question about, relying on our experience as a result of this lack of technology helping us out. So with week one on our viewpoint, which of the following is our managed product where opening and closing trades are placed at the net asset value price at the end of a trading day? Well, the fact that it's at the net asset value and at the end of the trading day really narrows it down for us. That's going to mean exclusively our mutual funds. So that's going to be our mutual fund possibility. Next one on the list, which of these is a security that represents ownership in a publicly traded firm? Well, that's going to be stock. Stock is the ownership in a publicly traded firm. Funds, ETFs, and mutual funds are conglomerations of investor money that is used to buy stocks or buy bonds or some underlying security. Number three, select the managed account that trades on an exchange and often tracks an index. We talked about this differentiation. Not always, but probably. An ETF is going to track an index. And indeed, exchange tells us that it is the exchange traded fund that is going to show up here. Stocks are also traded on exchanges, but a stock is not a managed product. Rather, it's a company, your share in ownership in that company. So ETF is the correct answer for number three. Number four, this term is used to define the overall size of a stock. I prefer to think of it as the size of the company, but it's the size of this stock. We're thinking of this as the market capitalization. Valuation is it too expensive or is it not expensive enough? Is it cheap? Is it expensive right now, on sale or not? Dividend rate is how much they're paying us in dividends. Height is just how tall Troy is, not myself. So as we take a look through this list, market capitalization is the correct answer for the size of the stock. We would add up the share price per share and multiply it by all the outstanding shares. And believe it or not, folks, the companies often have over 1 million shares outstanding, even hundreds of millions in some case. Lots of shares outstanding. And that makes sense when you realize that a company like Apple, like Microsoft, have valuations in the trillions of dollars. Yeah, they've got to have a lot of pieces of that particular pizza in order to add up to $3 trillion. Which portfolio allocation would be considered to have the highest risk? The highest risk. Remember, we saw that kind of sliding scale with circles up and to the right and down and to the left. And the higher up on the riskiness scale we went, we also found ourselves having more and more stock. Assuming that we're looking at the same quality of stock and bonds, we're thinking that that 100% stock portfolio is going to be riskier than either of these others. Which of the following is not considered a sector? Now, this is kind of a trick question, I'll tell you here, folks. But healthcare is, energy is, financials is, oil, gas, and consumable fuels is a subsect below energy. It's called an industry. So there are two industries inside of the energy sector. Oil, gas, and consumable fuels is one of those two. So be aware that, yes, this is a valid way to dissect the market. It's just not a sector. Maybe we're splitting hairs a little too much on that one. Name one sector that has overperformed historically during a recession phase of the business cycle. Do you remember how we saw our chart showing all the different types of information, when they were good, when they were bad? So all we wanted to do is go ahead and pull up that table, whether on fidelity.com or a copy of the slides that you had kept, and that would tell you that there are several that outperformed during that time frame. It was communication services, consumer staples, healthcare, and even utilities all overperformed historically during recessionary periods in the business cycle. An investor looking for diamonds in the rough, companies whose stock prices don't necessarily reflect their fundamental worth, would be most interested in what type of stocks: value, growth, or blend. Now, I consider this to mean that we are looking for value companies. But as I talk back and forth with some of my counterparts, they think this question is pointing you towards growth. It all depends on what we're thinking of when we consider these diamonds in the rough. The big difference between value and growth: value is a company that currently has earnings, and you're buying it based on its current earnings, not so much on the basis of a growth in those earnings. That's the big difference here. Are we talking about an expectation that the company has to grow their earnings to justify today's price? Or does their current earnings and business validate that value in here? So depending on how you like to dissect that, choose A, choose B. C is not the correct answer on this one. Project. We asked you to go to fidelity.com on your portfolio page, select the analysis tab. We did this right at the end of the class last week, remember? Oh, for your portfolio, determine the current allocation. How much stock, how much bond, how much short term? Do you have any international exposure? Also identify the market cap and style. Remember, we had to click into the stock section for that. So we aren't going to click through that again here, but thank you so much, folks, for paying quick attention there. Hopefully we hit some of the main questions that you might have had as we ran through there. Again, feels just like we were flying just a little bit blind without the chance to rely on your questions. But folks, we'll go ahead and do our best, marching us forward into today's presentation with our current material. Over to you, Troy.
Yeah, thanks, Jake. Good afternoon, everyone. Welcome back. It's good to be with you again, talking about, as Jake mentioned, these foundational aspects of trading, of investing. And I would say for those of you out there who are new, maybe there are some of you out there that are more experienced, more seasoned, have been trading a lot. Maybe you're going back to basics. Maybe you're reviewing things. I would say, and I would encourage you, don't despise humble beginnings. In sports, I like to use a lot of sports analogies. We really want to master the basics. And I think they're so important. I think they're going to help us with a lot of complex aspects of trading. And of course, this is a basics class, so we're going to try to keep it simple. We're going to keep it hopefully pretty straightforward for you. But what did we talk about in week one? We talked about what to trade, kind of the what, the why. Why might somebody trade? What do you need to be a trader? You need time, you need the desire, and you need the ability to trade. If you have the time and the desire, we know there are some people who are very busy. Perhaps you're a working professional, perhaps you're retired and you have lots of time on your hands. Perhaps you hit the lottery and you came into some funds. If that's the case, please call Fidelity if you need any and all assistance. But if you have the time and the desire and you're maybe don't really know a lot about the market, maybe you know some, not as much as you would like, that ability, that's where we really want to help you. We want to inform you, we want to equip you with the knowledge and the information so that you can have the highest likelihood of being successful. Full disclosure, trading is very difficult, involves tons of risk, and it's not out of the ordinary to have a situation where, hey, I could place a bad trade. You can have a really complex and thorough research process of a stock, of an ETF, of a mutual fund, and sometimes things just go awry. But let's go back to basics and let's talk this week about some of those methods of research, some of those methods of analysis. With trading, I like to talk about what some might refer to as the life cycle of trading. The trading should have, and again, everyone's going to have a different process. We encourage you to develop your own process, trade in a way that makes sense to you, that matches well with your style, your approach, your preferences, asset size, all of that, different considerations there. But we want to have once we have some kind of framework of what type of trader we are, why we're trading, what type of opportunities we're looking for, we want to find ideas. We then gain an idea, and then we go into that research and analysis. Hey, I want to trade this stock. Here's an idea. This stock looks interesting. This is a company. Maybe I use the product or service myself. Maybe I heard some news on TV. Maybe I read an article in the news. Some third-party outlet, maybe right on fidelity.com. Maybe you used some of the very popular tools on fidelity.com. We might have some time today to show some of those, such as the stock screener tool or some of these many other tools. But then you want to evaluate, okay, I perhaps am attracted to this company, the product, the service. How do I know this is a sound investment? Am I making a good decision? Is this a reasonable conclusion to put your own capital at risk with the expectation that we're going to get appreciation, income through dividends, some type of gain or appreciation along the way? We'll talk about this. We'll talk about things like analyst opinions, analyst reports. All of this can really factor into or perhaps be a part of our process. So again, we're going to take big picture considerations, and we're going to start with very simple kind of approaches to research and analysis. So what we're going to do is we're going to talk about the two primary, I would say, schools of thought, for lack of a better phrase. The two primary schools of thought are going to be fundamental analysis and technical analysis. And Jake, this always makes me laugh. In classes in the past, we've usually have polled the audience or we asked the audience with the Q&A open. I know we're having some technical difficulties again. Apologies for those for that, folks. But we've asked people and clients in the audience before, do you use fundamental analysis? Do you use technical analysis? Do you use both or do you use neither? And I love when a client or people say, I use neither. And and then I ask myself, okay, well, if you don't use either, what do you use? Do you throw a dart at a dartboard with ticker symbols? Do you read tea leaves? What do you do to make decisions? And I would say of all the different approaches, it's going to fall into one of these two schools of thought. Even if you throw darts at a dartboard, perhaps that's an aspect of technical analysis. Maybe you have some kind of a process. But again, by and large, these two processes are the main two ways decisions are made in the investing world. So let's tackle these. And Jake, anything you want to add to that so far?
Yeah, well, the interesting thing is some of it sounds crazy, right? I mean, I once read of a study that looked at the weather in New York City as the reason that prices move around. But curiously, it turns out that actually did have some play together with how prices move, right? So as we look through all these different avenues, whatever it is that's going to be your reason for determining how you're going to make your decision, find whether it applies and whether it adds some value. And that's our goal here. So if we take a look at this one, we're looking at a fundamental analysis data set right here. This is what's called the balance sheet. It's what a company has. It includes their assets, their liabilities, and their shareholder equity. In other words, after they take all the stuff they've got, their assets, take away all the liabilities, stuff they owe, their debts, what's left? And this gives us then an idea of, well, is the company worth anything? is at least a starting point in this. But unfortunately, it doesn't give us a clear-cut answer. These are accounting statements prepared by highly compensated and well-trained accountants whose job it is to help smooth out strangeness in year-to-year pricing. Let's just think about one example that could show up if we're thinking about a business. What if a business needs to set up a brand new fleet of vehicles? They're going to start having their employees drive some specific vehicles, and they have to go out and buy 20 of these vehicles. They go out and they spend a couple $100,000. Well, those vehicles are going to last more than a year, hopefully, probably more than 2 years, more than 3 or 4. Hopefully, they're going to last 5, 6, 7 years into the future, maybe longer. But the expense happens right now in year one. And so it's not quite fair to say that, you know what, we're going to count the entire amount against the company right now. It's an expense that's going to cover the next several years. And so accountants try and smooth that out using well-accepted principles. In fact, they're called the generally accepted accounting principles to help us understand overall what's the health of this company, what's happening accounting for all of those years-long investments. What about when I buy a big new manufacturing equipment? How is that going to change my value over time? Well, these accounting statements aren't just pure dollars and cents on what the company is worth. Instead, they're using some of those forms of accounting wizardry to change the numbers to things that make sense on a long-term basis, but don't necessarily mean that if we take a snapshot view right now today, that this is everything the company ever has had or ever will have. Rather, it's just giving us an idea, especially for historical trends and for comparability against its competitors. So what are we trying to learn if we measure this using what they call fundamental analysis, studying this balance sheet, studying the income statement, which is where you hear about the top line or the bottom line. You've heard those phrases show up even outside of the business world. The company's revenues and their net income are the other names for those two values. The top line is that revenue. Take away all the expenses and you get down to your net income at the bottom. Well, a fundamental analyst's job inherently is to say, how much should this company be worth? They walk into a grocery store and wonder, how much should this loaf of bread be worth? They're not so much looking at the price tag currently of the loaf of bread. They're asking, you know what? I've noticed that the prices of grain has been going up recently. That's going to be a factor on the costs of this over time. I know that, you know what? The CEO of the bread company just resigned. Okay, that's going to change things in this business. They're thinking about everything behind the scenes as well as the product itself and comparing it to its competitors. That's what a fundamental analyst is doing. And then as a result, they say, this loaf of bread is worth $4 a loaf, or $2 a loaf, or $1 a loaf, or $10 a loaf, based on their analysis, regardless of what the current price tag is. Then they often publish that opinion and say, all right, this should be worth X number of dollars. They say, Microsoft, you should be worth $200 per share. Or Apple, you should be worth $6 per share, or whatever number that analyst has come to. Then they say, therefore, you should buy, or therefore, you should sell. If the current price is less than what they think it should be, then they say you should buy. It's a discount. It's a deal right now. You should buy, buy, buy. However, if they find that the price is too high right now, they say sell. Get out while the going's good. Quick, run while somebody is still willing to pay you what they think it's worth. That's what a fundamental analyst's job is. Now, I'm going to tell you that puts you on a little bit of a high pedestal. It means that, number one, you can determine the right price for the security. Number two, it means that you can arrive at that determination faster than the rest of the world. Faster because you need to be able to take action. If you think the price is too low right now, meaning you should buy, then you need to have time to buy before, and this is number three, the rest of the world agrees with you and buys alongside you, pushing the price up to the value that you believe it to be. Now, like I said, that puts you on a little bit of a high pedestal, saying I am smart enough or smarter than everybody else in the world, faster than the rest of the world, but then they're going to figure out I'm right and join me in my current mindset. However, that doesn't mean fundamental analysis is worthless. In fact, it's heavily relied upon by all major investment firms, taking a look at what these companies are. It helps us understand the nature of the business and whether or not there is underlying value in them. We currently are viewing a strange scenario in the world where the quote unquote meme stocks have resurfaced. They previously made their showing back in 2021 and they went crazy high, right? Well, today they happen to be doing some of the same, where their value is not based upon the value of the company, but rather the house of cards that we as investors or traders are building for them. Now, that may likely come crashing back down in the near future, who's to say? But we should be aware that a fundamental analyst is going to rely instead on what the company's business is. What should they be worth? That's the fundamental analyst's job and the fundamental analyst's goal. And so when we look at that balance sheet, that's our key determination. The good things is that it helps you determine, like the bottom left area of this slide says, it helps you decide if the company's a good company. Should I invest in this? Does it seem like one that's going to be around for the long term? Are they innovating? Are they growing profits? Have they found a niche that nobody else can really get into? In Warren Buffett's famous terms, he says, is there a good moat around this business that nobody else can take our profits? That's what we're looking for as a potential fundamental analyst. The downside is it doesn't necessarily help you with a few of the other decisions. Like, if it's a good company, it probably was a good company yesterday and probably will still be a good company tomorrow and probably was a year ago, probably will be a year in the future. So when was the right time to buy? Is now still a worthwhile time to buy? And when would it stop being a good company such that we should sell that investment in time? As a result, we've got a hard time measuring out this risk versus reward. If I buy this quote unquote good company, when does it become bad? If I say the company should be worth 200, but right now it's only worth 100, well, that sounds like a great deal. But what if that $100 company today then goes down to 75? Well, now it's on even greater sale, an even better deal. And what about at 50? And at 25? And at bankruptcy? Well, eventually we need to pull our head out of the sand and recognize there may be evidence to the contrary. These are analysts' opinions on what the company should be worth. And then there is the current value of the shares. So that is the weak point, if there is one, to fundamental analysis. And so we do have something we can rely on that helps us. In fact, it's the most commonly relied upon second version of analysis that exists out here. It's one that Troy, myself, and the team use regularly and display for us. It's called technical analysis. Maybe, Troy, you can help us understand some of the key assumptions that we rely on in the technical analysis world.
Yeah, absolutely. So fundamental analysis is the study of the company. And we'll come back to that and we'll compare and contrast these two approaches. I think one of the really interesting takeaways of today's session that I encourage all of you is to really take some time to consider which of these do you think is going to be more helpful for you in your decision-making process. And we'll talk more about that. There are some pros and cons with really anything. I think it's a good exercise to be a little bit of a healthy cynic with both of these approaches. There's going to be some merits, there's going to be some drawbacks. So comparing fundamental analysis, the study of the company, well, what's technical analysis? We're not studying the company. We're studying market data. We're studying the chart. Technical analysis is the study of price, volume, and time. Those are the only three inputs: price, volume, time. Everything else is some derivative of those three inputs: price, volume, time. We can't reverse time. Time keeps on moving. There's a famous song that time keeps on slipping into the future. It does. It keeps moving. But how does, if we look at different aspects of time, a year, 1 month, 1 day, if we look at a chart that each little segment is maybe an hour, a minute, 5 minutes, different aspects, different contexts of time may be more valuable to different traders who themselves have different time frames by which they seek to identify opportunity with their own trades. So technical analysis is the study of past market data. Notice past data. With fundamental analysis, it's also past data. We can't study future data because it hasn't happened yet. This should be a no-brainer, but sometimes I think it's worth kind of revisiting some of these concepts. So we're assuming that stock prices are determined by supply and demand, not crazy meme stock short covering, but there are different market dynamics that can sometimes disrupt these foundational forces of supply and demand. Sellers put supply, more shares to the market, right? They are selling away their shares. Buyers are grabbing shares. That is the demand. That is supply being taken out of the workable supply. Of course, we know there's market makers who are going to make sure the market's efficient. So in many circumstances, there's going to be, if we're trading an established stock or an option or some other ETF that's on an established exchange, there often will be a intermediary party that stands ready to take the other side of our transaction. There's many other things that we should take a look at and keep in mind. We want to, with technical analysis, we want to try to pay attention and understand shifts in supply and demand, identify things like reversals, identify things like patterns, patterns of trend. If after today's class or this month's class of the trading basics, you might decide to join us, we have a separate class on just technical analysis. We also will host a number of sessions where we'll understand and we'll take a deeper dive into some of these pillars of technical analysis, like trend, momentum, volatility, support, and resistance. So all of those concepts are going to factor into technical analysis, the study of charts, the study of past market data, and this information is going to fuel our ideas, our thesis. It's going to be a way that we can make decisions for trading. You know, arguably, technical analysis is the most popular way trading decisions are made. That's not to say that technical analysis is better than fundamental analysis. Arguably, these are two foundationally different approaches in terms of what they're trying to accomplish. There's a great interview that I would really encourage many of you to take a look at. You can find it, I'm sure, on YouTube or it's in some archive. It may be at a TED Talks. It may have been at some popular investor conference. Seeking Alpha is one of those that comes to my mind. It's a past interview of Jeff Bezos. He's now retired as the CEO from Amazon. He's no longer at that helm, but he's giving an interview where somebody is asking him about the value of Amazon, the value of their company. And he recalls what happened right along the dot-com boom. And he said there can be times where the stock is not the company and the company is not the stock. And he says, we did a very comprehensive review of all our internal metrics. Our per unit profit of every unit was going up. Our revenue was going up. Our cash flow was improving. All of these things were going good, but our stock literally almost went to zero. And so there can be times now, folks, if you're old enough and you were trading or you were investing around the early 2000s or late 90s, I'm sure you'll remember there was crazy mania about the birth of the internet and what it could hold for the future of companies. And so there was this euphoric overexuberance, and there was the subsequent aftermath, which was the sort of, for lack of a better phrase, the gravity that went into some of these companies that went public that had no profit. They basically just had .com after their name, and many of them went bankrupt and went out of business. And the stock prices and many other stock prices of many other related internet companies that did have profits went with them because investors and traders had this mantra, this mentality of sell first, ask questions later. And so sometimes that value aspect is there a stock, is there a company that merits attention where the stock price maybe doesn't reflect its underlying intrinsic value? So I think these are some of the aspects of fundamental analysis. With technical analysis, we want to understand patterns. And why do we want to understand patterns? Because patterns tend to repeat themselves. Not always. This is not some magic way we can tell the future and say it happened once, it's going to happen again. But traders, investors, we have a memory. The market has a memory. And oftentimes, if there's certain levels on a chart where the price tried to get there and it wasn't able to hold, if it tries to go there again, that same process might also play out with, in contrast, if there's a certain level where the price tried to get there and wasn't able to get there and hold, if it later goes there and then passes, that can sometimes tell investors and traders something is different here. Something's different. Something has changed with this stock because now it's going higher than a certain level that previously it wasn't able to take and to hold. So often, even though we can potentially use fundamentals, we can also use technicals. These processes, these techniques, these methods of research are not mutually exclusive. They don't have to be one or the other. We can use an aspect of both. We can be a fundamental investor that looks for technical signals. We can be a technical trader that seeks to better understand the company that we're holding. If we're holding a company overnight, maybe I want a company that has low debt. Maybe I want a company that has growing sales. Maybe I want a company that has positive cash flow. Maybe I want a company that trades at a certain PE range. Whatever the metric is, it could be an additional layer that could filter what might we own of stocks that we trade or what might we look to trade before we even look at a chart. Now, again, what are some other things we want to take into account when understanding and better utilizing technical analysis? Well, there's different schools of thought. Again, I'm not an economist. I have studied some economics, but there are some thoughts that, hey, if the market and if prices, if people are rational and all the prices are included in the chart, then if we look at past data, it's just that, it's past data. What can we possibly glean? But folks, I don't know about you, and Jake, I don't know about you, but if we say all humans are rational and make rational decisions, I would vehemently disagree and say there's also behavioral economics, which understands concepts like fear, greed, crowd mentality. Perhaps some of you have been at a public, very crowded area, and suddenly there's a rush to the door. Or maybe you've been on I'm from New York myself, so maybe there's a subway and suddenly a lot of people are jumping into the subway for fear that they're going to miss it or that there's another subway that they're going to that's delayed that they're going to miss. There could be a lot of crowd behavior that we see play out with charts and with stock prices. Jake, I'm sure you've seen many play out yourself.
Yeah, absolutely. Not in the subway. The only subways near me serve a 6 inch and foot long, not so much a ride to where I'd like. But as we take a look here, technical analysis, the big thing that we're looking at are our assumptions. It would be unfair for me to tell you all those high and mighty assumptions a fundamental analyst makes, but not those for a technical analyst. To be fair, both of them are making assumptions which are unlikely to be true on a broad sweeping scope. But nonetheless, the analysis provides value. What does a technical analyst assume? The technical analyst assumes that the price for that loaf of bread that we looked at in the grocery store is the right price. They're not worried about what else is happening out there, what's the price of grain or anything else. They're worried about right now, what is the price of this loaf of bread? And they remember that last week, the price of bread was half as much as it is now. Well, maybe I better buy now before the price continues to go up. They're interested in taking advantage of the observable trends that tend to appear in the price action. They're not saying that they're a good company. In fact, some technical analysts don't even know what the company is that they choose to trade. Now, personally, I feel like that's going to a bit of an extreme. Again, putting our head into the sand a little bit. But instead, as we think and look at this, what we are understanding is that a technical analyst assumes that the current price is the fair price. That's why people, buyers and sellers, are willing to shake hands at that price and make a deal. That's what makes a deal. So a technical analyst relies upon that current price and the existing trend in that price. You've been looking at this screen in front of you for several minutes. Were you able to identify periods where the price seems to be moving consistently up or down? It does not appear to be entirely random. Although each individual candle, red or green, could be large, could be small, could be up, could be down, nonetheless, when paired together over time, we see the beginning moving more or less sideways, then straight down for a little while before bottoming out there at the lowest part in the chart, and then finding its footing and moving in a overall trend to the upside. Sometimes there were small downs along the way, but nonetheless, the overarching theme during that latter half of the chart was an upwards trend. A technical analyst simply says, well, it seems like it's going up. I guess I'll hop on the train and let it ride me to where I need to be. So that's what we're looking at. Now, we're going to start showing you how you can do this. I know that it may have felt like a lot of waiting before we finally get to you doing something. Last week, it was, what are these things that we might be able to trade? This week, we talked all about the forms of analysis that exist. Well, now we get to jump over to fidelity.com, and I will show you where we can go ahead and swing through and take a look at some of these ideas and where you can get answers to your major questions right now. You mentioned for a moment there Amazon, Troy. So let's use Amazon as our starting symbol, as a security to take a look at. Maybe we'll bounce through a few others. But all I have done here, folks, is go to fidelity.com. And I use the little search bar in the top right-hand corner. I typed in the symbol or the name of the company that you're interested in. And here we are looking at Amazon as a result. We see that it's trading for $187 per share. And that's up a little bit compared to yesterday. This is the normal kind of stock quote information that we usually receive when you look up or hear about a company. What's it doing right now? Also common for us to see something like this price chart that over time, maybe it went sideways for a while, went down for a while, has been going up recently. This is similar to what we saw on that chart on the slides. In this case, this is a 5-year view, which each individual candle representing 1 week's worth of information. But let's see if we can't start off first with the fundamental aspects. Finding out, what is this business? As Mr. Bezos said, it could be that the business and the stock are not always the same. So let's learn about the business first. To do so, there's a few spots we can come here. One is to come all the way over here to our statistics. If I click on statistics and I scroll down just a little ways, we will find a tile labeled financial statements. I'm going to go ahead and click in more right here. And it will tell us that we have a balance sheet, which looks awfully similar to what we were viewing just a moment ago on the slides. In this case, reformatted just a little. We had to adjust the screenshot you saw so it would fit all on one slide. As you can see, I have to scroll to view all the different lines visible here on this page. But it starts with, what is the company have, its assets, what are its liabilities, and then is left then with our shareholder equity. All told, that's the balance sheet. Our income statement is similar. It starts with our overall sales or revenue, the top line, how much money was paid to Amazon, then the cost of all the stuff that they sold, leaving them with their overall profit. Oh, but then we need to take out the costs of all the marketing, some of the other administrative stuff. What about paying for our buildings? Oh, and then we need to take out those strange things that I mentioned before, like I bought a building several years ago, or a car, or a machine to manufacture things that I haven't gotten all the value out of. That's called depreciation. And so on and so forth, every line down this list until we finally get down here in the bottom, our net income. And it turns out that Amazon is making $10,431 per quarter. Does that sound suspicious to anybody? $10,000 Amazon, that's the best you can do? There's probably some people here in the room that make substantially more than $10,000. We notice up here in the top right-hand corner, oh, that's $10,000 million, or in other words, $10 billion in that most recent quarter in profits after paying all expenses. Now I'd be shocked if there's somebody in the room that's making more than that on a quarterly or yearly or has in their lifetime. But if you are, welcome. Thanks for joining us. As we take a look here, folks, quarter after quarter, that's what we are understanding about this business. That's what the business is, and they're generating a lot of income. But I have this lesson that I repeatedly refer to for my sons. I have two young sons, one age 8, one age 11, and they're getting their feet under them in terms of finances, understanding the value of things. But they're still at that age, I am too, frankly, where when I look at something awfully sweet at the grocery store, I'm inclined to say I want to eat it. I want to own it. I want to buy it. But at what price? Do I still want the Tootsie Roll Pop if they charge me $10 for that Tootsie Roll? No, I don't even give it a second thought. But for a nickel, I guess I'll buy 100, you know? You just have to make your decisions. But regardless of the situation, the price and the item are not necessarily the same. As much as we might love the item, as much as we may value Amazon's $10 billion of net income every quarter, that's really sweet. Does that mean you want to buy it? Not necessarily. And that's the additional analysis we need to come to. Just like my sons ask, oh, so that's expensive, is what they'll say. Or they'll say, oh, that's really cheap. After asking what the price is and comparing to how much they wanted. So as we look at Amazon and we say, okay, $10 billion per quarter, is that expensive? Is that cheap? I don't know. Well, one of the ways we can understand this is by looking at the earnings per share. After we divide up all of this $10 billion and divide it into all the shares that exist for Amazon, it turns out there's almost precisely $1 worth of earning per share. So how much would you pay in order to get paid $1 per quarter presently? It turns out Amazon investors are willing to pay $187 right now in order to get paid $1 of profits per quarter. If it stayed at that same rate quarter after quarter after quarter, well, that would only be a small overall value over the course of time. In fact, it would take a long time for Amazon to work out that grand total of value and earn you that money back. That's what's called the price to earnings ratio. If I was to let Amazon just continue earning me $1 per quarter, how many years would it take for me to make my money back? Well, a quarter is 4 to a year. So if you add up these 4 and get roughly $4 per share and divide that $4 into our current price, well, we'd have to say, it's going to take a long time, Amazon, for you to get me my money back presently. Years currently. Decades currently. That's what's called the PE ratio. Luckily, you don't need to do all of this calculation yourself. In fact, if I go ahead and hit close and come over here to key statistics, that PE ratio that I've just described for you is this one right here. It turns out it would take 52 years at their current earnings rate in order for you to generate your money back, in order for you to earn the $187 again back on top of what you've already got. That's what's happening in terms of fundamental analysis. And that's the starting point for our decision as a fundamental analysis. But again, we would want to compare that and understand, is that good? Is that bad? I'll tell you, that's a high number. That takes a long time. And we can see that already right here by clicking on the industry average, which tells us that In this specific industry, which if we go ahead and click in, it will tell us that Amazon calls itself a broadline retail average. So this is comparing against other companies that also sell to retail customers like Amazon does. Well, other ones are only at a 34.8. It only takes 34 years to make back your money in some other companies. So depending on what we view about that specific value, now we see that Amazon is actually trading more expensive than some others. Does that mean it's not a good company to invest in? Not necessarily, but it does mean that on the basis of their old earnings, you're paying a lot currently. Do you remember the last question on the homework? What does that imply about Amazon? Why would people pay more for Amazon earnings than they would for another company's earnings? The answer is that they wouldn't unless they expect something different in the future. TTM, standing right here, means trailing 12 months. Over the last 12 months, this is what Amazon has delivered. But suppose you've been looking into the Amazon business, you recognize that there is huge opportunity right now for Amazon as a company. Sure, Jeff Bezos left the helm to somebody else, but they've got some amazing products, or they have an undeniable hold on the American online delivery market, or whatever it is you think that is absolutely going to drive their profits. Maybe that will grow those earnings next quarter and the quarter after and the quarter after. If we came back to the financial statement, look at the income statement, and then come back down here to our bottom line, take a look. Quarter over quarter, this one was actually a little less than last quarter, but more than the one before that, more than the one before that. And if we compare to the one a year ago, they 3 times their earnings for this quarter compared to a year previous. Oh, so it's the fact that they might earn substantially more in the future that justifies, at least in the minds of buyers of Amazon, the current pricing. That's the type of analysis you are doing as a fundamental analyst. If that sounds like your cup of tea, something that's interesting to you, let me just point you to 1 or 2 resources where you could go to find this stuff on fidelity.com. Again, I would highly encourage you to come to the page for the stock that you're looking at, go to the statistics, and explore both the financial statements as well as the key statistics. To be fair, folks, I want you to know that these are summarized versions. And I know that a few of you were looking at this and your eyes rolled into the back of your head because it was too much already. If you're one of the few who thought this was hardly enough detail, I need more, well, you're going to come down here to the actual report that the company filed with the SEC. It's a couple hundred pages long every quarter, telling you everything about the company. What about AWS, their Amazon Web Services? How does that part of the business generate its profits? What about all of the stuff they do with Amazon Prime? Are the subscriptions doing well or are they doing poorly? Do they view risks to that in the near future? What else is happening? Why did they cancel the project related to Alexa? And blah, 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 blah. Every little detail, that's where you're going to go. If you want the full depth, this is where you look. Scrolling up, for those of you who had your eyes rolled to the back of your heads, now is your time. Click on sentiment for me. Click on sentiment, and here under the sentiment tab, we've got it very simple. All right, we don't have line after line item, now just 4 areas, and these ones are very conveniently lined up. They're standardized for us by S&P Global Market Intelligence, and what they're doing is now comparing against everything else in the consumer discretionary sector and saying, all right, what's Amazon like? Valuation from 0 to 100. 100 is good, 0 is bad. They're kind of middle of the road. They're mid. Overvalued, undervalued, no, they're right here in the middle, valuation-wise. Quality of their earnings is what this is talking about. Ooh, okay, that's actually pretty high. Top quintile up here, 82, nearing that 100 mark. Excellent. What about the stability of those growth that seems to be priced in to the current value? Stability is relatively high, again, on the higher end. What about their financial health? Oh, here you've got a little bit of a question mark, again, a little bit of a mid here, not high, not low, but maybe somewhere average. Here, you've already got some answers. As a fundamental analyst, this is a starting point to say, all right, this is what's going on in this report. The next spot you're going to come to, folks, is right here under analyst ratings. Analyst ratings, and we're going to focus on this right-hand area known as research reports. If you would like to know grand total, what do people think? I want somebody with a fancy degree and years of training to do the studying for me. Well, we're happy to do so. That's kind of our business, right? Well, there is a qualified analyst at Forward Equity Research and ISS EVA and Argus Research and each one of these different firms studying Amazon and saying whether they think you should hold, sell, or buy. The names differ just a little bit, sometimes based on the strength of that, but neutral means just holding right here in the middle. Sell and underperform mean they think it's going to go down or at least worse than the market. Buy and overperform would be if they think it's going to go up. But as we take a look, we also have a date here telling us when the firm issued the report. Let's glance at this one from Forward Equity Research. And when I click into it, here might be a little bit more of what you're expecting. For example, this tells us that Forward Equity Research currently views these to be the good things on the company, very positive in terms of its recent price movement, low on its neutral, and earning strength actually views it to be negative. We can scroll down and see what is going on in the company, upcoming earning strength, clear expectations, and alignment all throughout this time frame. And often in these reports, they will also expose for you their expectation for earnings for this company and a future price target. So if you're interested in seeing this done by a professional, this would be the area that you would come to glance at these different reports. They're made freely available to all of our customers. All you need to do is log in and you have access to all of these at a click of a button. So that's for you fundamental analysts or those that think that might be an area you want to check out. That's our starting point for these. Again, clicks to get here. We went to the search bar in the top right and search for the company we're interested in. I took you through the statistics area. That was to look over here at the ratios and over here at the balance statement and the like. We glanced at sentiment to see the really simplified version, and analyst ratings to see these actual research reports by qualified analysts out there. So hopefully that helps you as a starting point to this. But we also have resources available to you if you think you might lean instead towards that technical and analysis bit. Troy, you mentioned some of our classes. That's certainly a good starting point for many of the folks in here. Anything else you would point them to?
Yeah, a couple things, Jake. I know we're coming to a close. There's so many tools, and I think the takeaway is there's many different things that Fidelity offers. And again, part of our, kind of goal here in terms of equipping you, making sure you have the ability, if you have the time and the desire to trade, to invest on your own, we want to give you the tools. We can't promise infinite riches and success, but again, we want to at least equip you, arm you, and give you the best chances of being successful and have the best investing and trading experience here at Fidelity. I'm going to say there's three primary places on Fidelity's website and Fidelity's in terms of package of products where you can trade and look at charts. So if we're on that same resource that Jake was showing us, now we could have gone, like he said, in the upper right-hand corner, just typed in Amazon. We could go to news and research, type stocks. It'll take us to a page. We could just type in our symbol, whatever way we want to get here. Once we're here, we have all of this data. A lot of this is fundamental data. So if you're fundamentally inclined to this is going to be your home and where you go to do a lot of that research. There's going to be three areas, though. If you're going to look more at charts and you want to do more charting, here's area number one, which is the Chart Plus feature. We host, again, whole sessions on the Chart Plus trading package in terms of all the indicators, its capabilities, how you use it. But with the last couple minutes I have, let me show you a couple quick things. It's a chart that you can grab. You can kind of move it around. You can adjust some of your axes here in terms of the y-axis, the x-axis. You can change some of your time frames. Again, with all of that information, right, all that fundamental analysis, should we buy the stock now? Is it going to be up in the next month, in the next 3 months, in the next year? Of course, that's the golden answer, right? If only we knew that, we would all be rich and successful. But if we look at different time frames of Amazon and Amazon's chart, let's look at 1 month. Okay, maybe a little bit sideways in the last month. Let's look at 6 months. Okay, it is higher in the last 6 months. Let's look in the last year. It is higher in the last year, 2 years, yes, et cetera, et cetera. So here's somewhere we can look and we can see if we look at 5 years, of course, it's higher than where it started. But between now and where it was 5 years ago, it's been a bumpy ride. And we know there's lots of things that have happened between now and 5 years ago in terms of COVID, in terms of understanding the American economy, consumer habits. I'm sure there's been times where Amazon reported numbers that were amazing and everyone's signing up for Prime. And maybe there were some quarters where, hey, maybe things are slowing. Maybe not everybody's a Prime person. Maybe people don't want, and maybe they prefer Walmart or they prefer Sam's Club or they prefer Costco or some other bulk retailer to do a lot of their shopping. So, again, we can understand the company. The chart's going to help us understand trends and insights into price, volume, and time. We host, again, a whole class on indicators, on many other things that you can use, such as moving averages, understudies, et cetera, et cetera. With the last minutes here, I'm going to show us the two other places we can go to do some of this chart work or technical analysis. So Chart Plus is spot number one. Number two, on the upper left-hand corner of your screen, you'll see accounts and trade. There's what's called the trading dashboard. And many of you should have access to this. This is kind of a newer thing, so to speak, within, I would say, Fidelity's suite of tools. If you go to the trading dashboard, you may have to rearrange some of these. You might, for example, have your positions sort of sticking out here and the chart might be squished. You might have your news a little bit bigger. You can also, for example, full screen your chart if that's all you want to look at is your chart. And again, it's going to give us the same tools as the Chart Plus feature. But what's different is if we're a little bit more active, we want to maybe simultaneously look at a chart and look at some of our positions, or maybe we want to have simplified and quick access to place a trade. If we finish our analysis and we have some plan to manage risk, we have an exit strategy, we've evaluated the merits, the drawbacks, the risks involved. If we want some quick and easy way to place a trade, well, here it's at the click of a button. If we want to buy or sell Amazon, we can quickly pull up a trade ticket and make a trade promptly, provided, of course, we've done our adequate analysis and understand the risks involved. So Chart Plus is number one. The trading dashboard is number two. The third and final place, and arguably the spot where if you attend many of our sessions, we're going to spend a majority of our time here. If you go in the upper left-hand corner, just like we did with the trading dashboard, accounts and trade, just under trading dashboard, you're going to find Active Trader Pro. Folks, this is a separate standalone desktop application. You can't go there by going on a website. This is something you download. This is an application. As long as you have a login, if you have an account that's applicable for trading, so something other than perhaps a 401k, if you have a brokerage account, an IRA, maybe you self-direct your own HSA. If you have an account that's eligible for trading, you should be able to download and use Active Trader Pro. It is again, a desktop application that is more catered towards those who tend to be more active. I would say many of the tools here you can also access on fidelity.com, but it does give you the ability to add more personalized customization to your trading experience. I'll go ahead segue there now, and you can see, again, no fancy layout here. I just have a chart, and I have maybe a list of some stocks I'm watching. We could use a watch list. This is called our filters tool. But again, it's another different type of charting tool. It's going to work a little differently than the Chart Plus that was a little bit more free floating. This is a little bit more stationary in terms of the margins. We can kind of squeeze our chart up and down. You'll see here the window has stayed the same. We can change our time frames. We can look at a chart where we haven't really discussed candlesticks, which is a whole part of trading. Again, in a technical analysis class, we would go more into that. But for example, if we're looking at a longer time frame, our candles can be daily, can be weekly. We can look at much shorter time frames and say, okay, maybe I want to look at some of the trends of Amazon over the last, each candlestick is 10 minutes. This is only over the last couple days. We can see here it's made some lower highs, which is an important part of a downtrend. But today it's actually bounced a little bit here. Now, the golden question, just like uh, Jake showed us all these fundamentals, if we know all the fundamentals, can we predict the future of the stock price? I would say no. And with technical analysis, if we do all the technical analysis and we're experts at dissecting a chart, can we tell the future? I would say absolutely no, we cannot. However, what can it do? Both fundamental analysis and technical analysis give us more information so that we can apply a rigorous process of research and analysis to make sure we are making the most informed trading and investing decision. Make sure we are aware of some of the risks involved. Make sure we know, is this stock in an uptrend? Is it in a downtrend? How do we define what is trend? And does the company have a lot of debt? Does it have very low debt? Does it have good sales? As Jake pointed out, what are its earnings? What's its earnings per share? Does this company have earnings? Many young companies or companies that are new or developing don't have earnings. They initially have revenue and they'll post a loss for some time. If that revenue grows, and eventually they start cutting costs and scaling, and eventually they'll soon develop earnings. Not only do they have earnings, are those earnings growing? If I buy today and you showed Jake, I think, Amazon had something like, a 30 or a 50 PE. I don't know exactly the exact value. But for example, if a stock has a 50 PE, right, that means if we invert that value, that means you're only getting about a 2% earnings yield. In other words, the earnings is only 2% of the price you're paying. That's not a lot. But if those earnings are growing very fast, maybe in a year or two, those earnings will be instead of 2% of the price you pay, maybe it'll be 5, 6, 8%. That starts to look like a more promising number. And so it's not just right now, it's what does the future hold? And of course, folks, you want to make the best decision you can. Sometimes when you're presented with a lot of information, we can get what's called analysis paralysis, where we're unable to make a decision. So not all of this, just because there's a million tools and many things you can use, doesn't mean you have to use every single one. So we encourage you to develop a process to pick out a couple of these tools that you feel are going to help you make the best informed decision, narrow down these ideas, evaluate these ideas. Maybe it's a hybrid, maybe it's a mix of fundamental and technical analysis. Maybe you prefer one approach over another. You have to develop that for yourself. We're happy to show you all these different techniques, but at the end of the day, for as a self-directed trader investor, this is something that you have to develop for yourself and on your own. Of course, we're going to be there with you and assisting you along the way. Jake, I know we're at time. We covered a lot today. We talked about a lot. We talked about fundamental analysis, technical analysis. Maybe you want to share with us some of your last minute thoughts and some follow-up for the coming weeks ahead.
Yeah, so let's just wrap it up here, folks. Next week, we expect to have that question and answer back up and running. Come ready to ask whatever you missed out on this week. I apologize for that, Troy. I know you and I felt like that was a little bit crippling, but no worries. Thank you for roughing it with us, as it were. I hope it was still enjoyable. As I scroll down on here, the webpage I'm on is fidelity.com/classroom. Go ahead and head there, fidelity.com/classroom. Again, we are in trading basics. The reason you're going to come here is number one, if you were interested in getting a copy of those slides, it's all in one big file. So you can go ahead and download it here and you've got a copy of those. If you already did it last week, it hasn't changed, but go ahead and download a copy of those if you need it. Also available here is the homework. Go ahead and click on here and you will see the homework assignment that we're going to answer at the start of next week. So we certainly will use this to get those juices flowing again next week as we get the ball rolling. We'll talk all about these, answer your questions, and maybe we'll even dedicate a few extra minutes to answering questions right there at the start, depending on how interested you all feel that is needed as we start off next week. That said, going forward, we've got a few big ideas as we look through this. So last week, what could we trade potentially? Today, what type of research? Next week, it's going to be the actual placement, the mechanics. We're going to do click after click. How do I actually place trades? What are the order types mean? How do I choose it? How do I understand all of those? So that's what we're going to be going over next week. A lot of those actually mechanics. So if that's what you've been waiting for, wait no longer. Next week, same time, same place. And finally, once you started a trade, how do we get back out of there? What are some of the things to think about? How do we end this when the time is right? So we'll go ahead and share our thoughts with you in the coming weeks on those. Thank you for being with us. Normally we'd stick around for questions, but we'll have to forego and look forward to hearing from your questions next week. Thank you so much, folks. Thanks, Troy. Appreciate you all. Take care.